What's up, everyone? It's Scotty with Money Investing, and right now we're going to talk about how there is a massive short position against the treasury market, which is the treasury yield, and that's a literal bet against what I'm actually planning to go long for at the moment. So I hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below if you're interested in joining us. Of course, getting access to the buy and sell alerts, options alerts, trade ideas. There's a 16% annual discount that does expire tonight after midnight. So if you want to take advantage of that, link's going to be down below. So this right here was that report that came out earlier today. A big short in treasuries. Traders are building up bets around a debt ceiling resolution, and they are expecting this new issuance of about $500 billion to $1 trillion in treasury supplies that will drive up the yields, drive down the yields very, very quickly, and actually drive up the yields because of the bond prices going down. It's a bit confusing. Let me explain. So when you go short, you're expecting prices to fall, right? If you go short a stock, you're expecting a stock price to go down, right? Because you're betting on that stock price to go down because you're short. Now, when we talk about how there are massive short positions on treasuries, what they are talking about is the prices of these bonds. They're expecting them to go down and for the yields to rise, okay? And yields will rise if there is any concerns around the debt ceiling. Of course, if there's any risk around the debt ceiling, which is something that we have talked about in the past. I patiently waited up until the last few days to actually establish a position in TMF. This right here is the swing trade where we established a position in the $7, $7.70 around those levels, and it's up 4, 5, 6% from those levels, from that support at 730. Why? Because the yields sold off a little bit over the last couple of days. You can see that we got up to as much as 4.2%, and we're now down about 4.27%. So we got up to that level and we pulled right back down, and that was one of the reasons why I did wait until we got up to that level, until we got very close to achieving a debt resolution, a debt ceiling resolution, until after, of course, started to pull back, and we're starting to see that reversal happen. But right now, traders are betting that there's going to be a rise in yields once again. So speculators have been building historically massive short position in U.S. Treasury futures ahead of what could be a $1 trillion of new debt issuance on the heels of a debt ceiling resolution. And bond speculators have been taking up a large number of short positions in the 2-year, 5-year, and 10-year Treasury futures, according to the Macquarie team, which pinpointed the combined tally of contracts at nearly 3 million as of late May, or the most since 2000. So in over 23 years, this is the biggest short position that we've seen on the Treasury market. And they have taken Treasury shorts on 2-year, 5-year, and 10-year futures. So what they're really betting on is the idea that there's going to be, once the debt resolution, debt ceiling passes, which is a risk that I didn't really account for, $1 trillion worth of new debt will be issued, which is additional supply in the market. If there is no demand for that, for those new issuance, what's going to happen? Supply is going to overbalance demand. Prices are going to start rolling over, and what's going to happen with the yields? They're going to start jacking up, right? They're going to start pushing higher, and that's really what the thesis is, according to these speculators. But, and this right here is the chart, as you can see that we are, once again, bond speculators have taken up short positions in U.S. Treasury bonds to historically very high levels in recent weeks, setting up for a short squeeze. Now, if the demand comes in, the build-up matters because of much of Wall Street has been focused on the brief spike in yields on some Treasury bills due in early June to above 7%, which we talked about in one of my other videos as yields kind of crossed over 7%, the ones that are maturing in early June, or climbing U.S. sovereign CDS spreads as U.S. teetered towards the brink of default. CDS spreads also have been widening, and the actual demand for credit defaults have also gone up because of the expectation that the U.S. might default. But Macquarie's team thinks a more important development tied to the debt ceiling fight has been the significant number of wagers in Treasury futures in the past few weeks. A look at Commodity Futures Trading Commission data shows explosion of speculation taking hold in Treasury futures, with Macquarie's teams led by Thierry Wisman pegged as the biggest buildup in a short interest in 10-year Treasury futures since 2000. Short bets are wagers that prices of the stock or bond will fall. Since bond prices and yields move in opposite directions, fixed income speculators would be focused on the potential for yields to climb when the new Treasury supply outstrips the demand. That's exactly what I mentioned. So if there's a new issuance, supply will overbalance demand, prices will come down, yields will start going up. And they also mentioned that this heavy positioning likely reflect traders attempting to hedge away or sidestep the inevitable issuance of the new bonds, because of course when the debt ceiling gets passed, there is going to be a new issuance of bonds, right? Because that's how they're going to raise more capital. That's how the U.S. is going to raise more money to once again start spending on the things that they need. But they also mentioned that I don't think anyone is quite sure where the demand is going to be, because even if we do see a lot of issuance, a lot of it depends on demand. If the demand comes in very strong, prices will once again start moving up, yields will come down. If demand comes in line with the supply, nothing really is going to happen on a net basis. But if the supply is overbalancing the demand, that's when this thesis starts to play out. And they also mentioned, the team at Macquarie mentioned or thinks there's a potential for a short positions in Treasury futures to backfire if a flood of issuance from debt ceiling increases doesn't cause Treasury yields to rise. So they pointed out the 10-year Treasury yield climbed to about 3.8% late May from about 3.4% over the past few weeks. So that's, again, you can come over here and check that out. So US 10-year did go up, right? So this has been the significant move in the month of May of about 15%, got up to as much as 3.86%. But more recently, though, we have started to see it pull right back down to under 3.7%. Now, given the climb, they say they're not convinced that yields can rise further into the issuance of the new bonds. And the team said they also expect the pent-up demand for Treasury debt to keep yields in check, given the lack of new supply since the $31.4 trillion debt limit was breached in January. So there hasn't really been new issuances since the debt ceiling debate got started, and there could be a lot of pent-up demand in the Treasury market. So from a technician's perspective, the setup for a short squeeze that takes the 10-year and the 5-year yields back to around 3.5% with a little help from some downbeat US data over the next few weeks as well is very, very high. So what they're really saying is it's possible that it could be dropped back down to 3.5%. And of course, the US 20-year is going to move very much in tandem with the 10-year. And I'm going to really be eyeing for 3.7 or as low as 3.675% for the 20-year yields, which is obviously going to drive the TLT and the TMF ETFs to a little bit higher levels as well. So that really is the resistance that I'm watching at closer to 870 for TMF. That's going to be an upside of closer to 16-17% from those levels of 750. And of course, TLT on the day was up over 87 basis points, getting a very nice reversal on the other side in the MACD. And I'm really watching that resistance at close to about $109 per share on TLT as well. So let me know in the comment section below, what do you think about this short squeeze and the potential for a short squeeze, and the fact that we are in a massive short right now with the Treasury bonds, expecting with this new issuance to drive up yields and drive down prices at the moment. So let me know in the comment section below, what do you think? I am still going to be long on the TLT TMF trade because I do believe there is a potential for a short squeeze here, considering that there is a massive short, the biggest one that we've seen in over 23 years, and there is a lot of pent-up demand, and we're very close to finally getting a debt ceiling resolution in place. So let me know in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below. And 16% annual discount that does expire tonight before midnight. As always, happy investing, and I'll see you all in the next video.